Welcome back to the deep dive. Today we are really getting into the foundations of modern personal finance. We're tackling a concept that, on the surface, seems so straightforward.
Deceptively so.
Right, the fixed rate mortgage. But what we found is that it contains this surprising amount of financial mathematics, some really compelling history, and wild global variations.
It really is that three-letter acronym, FRM, that millions of homes are built on. And yet, as we synthesize the material, we just kept coming back to the fact that the very definition of fixed is, well, it's not universal at all.
Not even close.
So if you're tuning in thinking this is just a quick chat about a static interest rate,
Yeah.
you are in for a serious look at how time, inflation, and just plain geography can completely transform this one product.
So our mission today is to provide you, the listener, with a kind of comprehensive shortcut. We want to move way beyond the basic dictionary definition.
Absolutely.
We want to get into the origin story. I mean, why was this loan even invented in the first place? And then the precise mechanics of the calculation.
The math.
The inherent risks that come with, 15 or 30 years of supposed stability, and how the entire concept just shifts the moment you cross a national border.
So let's start at the absolute core, because that definition, even the simple one, is crucial. A fixed-rate mortgage is a mortgage loan where the interest rate stipulated on the note remains constant. It's fixed.
Fixed for the whole time.
For the entire agreed-upon term of the loan, no changes.
And that right there is the immediate benefit. It's the fundamental reason this product exists and why it dominates markets like the U.S. and, as we found out, Denmark of all places. It's all about budgetary predictability.
Exactly. Because that interest rate is fixed, your monthly payment is fixed, and the loan duration is fixed.
It's a trifecta of certainty.
And that level of certainty allows for long-term financial planning. That is,
right.
Well, it's just impossible with most other loan products out there.
That certainty really is the benchmark, isn't it? When you look at the whole landscape of borrowing, I mean, the sheer variety is staggering. The FRM just stands out for that complete fixation.
It provides a kind of bedrock of security, especially in a housing market that can be incredibly volatile.
And I think it's important to frame the FRM by looking at its competition, both now and, historically. We're not just talking about the modern adjustable rate mortgage, the ARM, where the rate floats or tracks an index.
No, the history is key. The FRM was a truly revolutionary answer to the, frankly, dangerous instability of the balloon payment mortgage.
I've heard of these, but they sound terrifying.
They were. It was a structure that forced borrowers to face this massive lump sum payment at the end of the term. You'd pay interest for a few years, and then, boom, the whole principal was due.
And if you couldn't pay it?
It often led to widespread financial collapse, foreclosures everywhere.
And even today, the FRM offers security against much riskier products that, believe it or not, still exist, like the negative amortization mortgage.
Oh, that's literally the opposite of the FRM's safety. It's a scary concept.
It is. In a negative amortization loan, your required monthly payment doesn't even cover the full interest that's due for the month.
So your loan balance actually goes up over time, even while you're making payments.
Exactly. You're digging yourself deeper into debt every single month. The FRM, by contrast, is engineered from the ground up for disciplined, complete debt retirement.
Indeed. We are really unpacking a product that was built for stability and for long-term planning, and every single feature of it, from its mathematics to its standardization, it all reinforces that one central goal.
Okay, so to really understand a fixed-rate mortgage, we have to look under the hood. There are these 4 constant variables that lock the loan in place and allow for that calculation of the fixed monthly payment. What are those 4 pillars?
Right. These are the constants that the lender uses to define your entire amortization schedule. So first, you have the amount of the loan. That's the principal, what we call $P1. The initial capital you borrowed.
Simple enough?
Second, the interest rate, or tweedles. That's the percentage being charged. Third, and this one is sneakily important, is the compounding frequency.
What do you mean by that?
It just defines how often the interest is calculated and then added back to the principal. And fourth, of course, is the duration of the loan, or no dollar, the overall term, usually in months or years.
That third point, the compounding frequency, is so critical because it immediately shows how the rules can change globally, even for the exact same concept. In the U.S., we just assume monthly compounding. It's the standard for all the examples you see.
But the research highlights that in a market like Canada, for instance, interest is typically compounded semi-annually, so every 6 months.
Well, so what does that actually mean for the borrower?
It's a subtle change,
But it means that even if a U.S. borrower and a Canadian borrower got the exact same nominal interest rate, say 5%,
Yeah.
the internal math of their loans, and therefore the actual amount of interest they pay, will be different.
Huh.
Because the frequency of that compounding fundamentally alters the path of the debt. It's one of those details that has a huge impact over 25 or 30 years.
Okay, so now that we have the constants, let's talk about the giant vulnerability. The thing that's created precisely because the loan is fixed for, say, 30 years.
Inflation risk.
Inflation risk. This is where that simple idea of stability gets really complicated really fast.
It really does. It creates the core paradox of the FRM. When a borrower commits to a fixed dollar payment for up to 3 decades, they are introducing this massive variable into the equation.
Which is the future real value of that dollar.
Prices. The lender is vulnerable if the dollar loses value, and the borrower is vulnerable if the dollar unexpectedly gains value.
Let's break down the two main scenarios that really show this inflation paradox. First, the high inflation scenario.
This is the borrower's dream scenario, really. If inflation rises unexpectedly and sharply, let's say it jumps from 2% to 8%, the person with the fixed-rate mortgage benefits tremendously.
Why is that?
Because inflation erodes the real present value of those fixed loan repayments. You're paying back the debt with dollars that have way less purchasing power than the dollars you borrowed years earlier.
So your debt is shrinking in real terms.
Exactly. The real debt burden, especially measured against your income, which is hopefully rising with inflation, shrinks dramatically. It's a mechanism that effectively transfers wealth from the lender to the borrower during periods of high, unexpected inflation.
That is just a stunning realization for a lot of people. The stability you bought is actually a massive hedge against a rising cost of living.
It absolutely is.
But the trade-off, the flip side of that coin, is the second scenario, the low interest rate scenario.
And this is where the borrower can get hurt. If economic conditions improve or if inflation suddenly drops, and that leads to significantly lower interest rates across the whole financial market.
So let's say new mortgages are being issued at 3%, but you're locked in at 6%.
You're worse off, much worse off. You are locked into an uncompetitive higher rate and potentially for decades.
You bought that certainty, but in this scenario, certainty means you're missing out on all this cheaper capital. You'd have to pay a massive refinancing cost to access that lower rate, which could wipe out a lot of the potential savings.
And this brings us right to the general market principle about the cost trade-off. Lenders, they're not dumb. They understand they're absorbing 30 years of inflation risk when they issue an FRM.
So they price that risk in from the start.
Of course. And that's why FRMs almost universally charge a higher starting interest rate compared to comparable adjustable rate products, or ARMs.
So the premium you pay on day one, that slightly higher rate, it's literally an insurance premium.
That's the perfect way to describe it. You are paying the lender for the peace of mind that they, not you, will bear the financial pain if rates jump dramatically over the next few decades.
And this inherent trade-off, it informs a really critical piece of scholarly advice that came up in the sources.
Yeah, this was fascinating. The data suggests that, as a general rule, borrowers should generally prefer adjustable rate over fixed rate mortgages, unless interest rates are low.
Okay, that's a powerful insight. Let's unpack that.
Well, if current rates are historically high, the potential for them to fall is much greater than the potential for them to keep climbing indefinitely.
Right. What goes up must come down, eventually.
In that scenario, flexibility, the ARM, offers the greatest potential reward. But if rates are already near historic lows, the risk of them increasing dramatically is much higher than the risk of them falling further.
So that's when you buy the insurance.
That's when the FRM, the expensive insurance, becomes a really smart, necessary hedge.
Okay, so when a borrower is thinking about the true cost of their mortgage, they have to look at 3 long-term components. First is the original loan principal, the P dollar.
And you've got all the expenses, taxes, insurance, closing fees, all of that.
And the third, and this is where the real leverage is the total interest that you'll pay over the life of the loan.
That's the number that can be truly staggering.
And that leads us to a fascinating piece of analysis from the source material, what we're calling the rate term puzzle. We all tend to obsess over the interest rate, right?
Completely. It's the headline number.
But the sources present these compelling examples showing that the duration of the loan, that no dollar variable, can be exponentially more important than the rate, $3.
Absolutely. The research offers a shocking completely counterintuitive revelation about the total final dollar cost of the loan.
Okay, so listen to this, because this one really made me stop and think. A loan structured at 2.5% interest for 30 years
Mm-hmm.
result in the exact same final total dollar cost as a loan at 5% interest for 15 years.
It's wild, isn't it?
It's insane. And to show this isn't just a weird anomaly, they give another example. A loan at 5% interest for 30 years has the exact same total cost as a loan at 10% for 15 years.
Let that sink in. Double the interest rate, but because you cut the term in half, you pay the exact same amount of money in the end.
I have to pause there. I mean, I spend so much time focusing on trying to shave half a percentage point off the rate. But you're telling me that doubling the interest rate from 5% to 10% doesn't increase my total debt burden as long as I cut the term in half?
That is precisely what the financial mathematics show. It means the long-term expense is disproportionately weighted toward the term length, the delaler.
So the time is more important than the rate.
Much more important. If you can significantly reduce the duration of time that the principal is outstanding, you completely neutralize what appears to be a massive percentage rate hike.
But why? What is it about that time factor that gives it such overwhelming weight?
It's the raw power of compound interest applied over decades. In that 30-year scenario, the interest is compounding on the outstanding principal balance 360 times.
Okay.
By cutting the term to 15 years, you are slashing the number of compounding periods in half down to just 180. Even if the interest rate you're paying each period is much higher, the simple fact that you stop that compounding clock so much earlier saves you an astronomical amount of money.
So when a new borrower is sitting down, they should be prioritizing finding the shortest possible term they can actually afford, even if it means accepting a slightly higher headline interest rate.
The math says yes, because the time savings will dramatically outweigh the rate difference over the life of the loan.
It just reveals this profound financial truth, doesn't it? The monthly payment is all about affordability today, but the total cost of the debt is overwhelmingly driven by the term length.
Which means the 30-year mortgage, while it offers the lowest monthly burden and is the most popular for that reason, is often the most expensive path to homeownership in the long run, by a lot.
Okay, so now that we understand the math and the risk baked into the FRM structure, let's look at its revolutionary history. This product, as we know it, was essentially invented in the United States.
That's right. And it was invented as a solution to a massive economic problem.
So we need to go back in time a bit.
We need to go back to the 1920s and early 1930s. The prevailing form of mortgage back then was the balloon payment mortgage we mentioned earlier.
The one where you pay the whole principal at the end?
Exactly. It was a non-amortizing loan. You only pay the interest every month, and the entire principal was due as a lump sum after, say, 5 to 10 years.
That sounds inherently risky, especially during an economic downturn.
It was devastating. Just imagine the Great Depression hitting. Your 5-year term expires in 1932. You're required to pay the entire principal back, but you have no equity built up, and the entire banking system is collapsing.
So there's no way to get a new loan.
Banks weren't lending.
Yeah.
You couldn't refinance. This refinancing risk caused widespread foreclosures, not because people couldn't make their monthly interest payments, but because they couldn't possibly meet that one final balloon payment.
Wow. So the instability of the housing market in the 1930s, where entire neighborhoods could be wiped out by a single balloon payment default, that created the urgent need for a better product.
And that's where the Federal Housing Administration, the FHA, became instrumental. They helped develop, and this is the crucial part, standardize the FRM by ensuring these new, fully amortized loans.
So the FHA insurance gave lenders confidence.
Total confidence. They knew they wouldn't lose everything if the borrower defaulted, which finally allowed them to offer these lower-risk, long-term, fixed products to the public.
And this was really the birth of the fully amortized loan structure as we know it.
It was. The loan was engineered from the start to be completely paid off, principal and interest, by the end of the term. This broke that terrible cycle of successive loans and constant high-stakes refinancing that had defined the previous generation of homeownership.
It was a massive societal shift towards financial security. And those classic U.S. terms, the 15-year and 30-year mortgages, they became the foundational model for decades.
The gold standard, really.
But the U.S. model isn't static. The research notes that in really high-cost housing areas, it's just especially along the coast.
Sure. Where a standard 30-year term still leaves the monthly payments completely out of reach for average families.
In those areas, we are seeing these controversial new variations pop up.
We're talking about the emergence of 40-year and even 50-year mortgages.
50 years, that's a lifetime.
It's a painful realization of the affordability crisis. Lenders are using the only lever they have left, the dollar variable, the duration, to make the monthly payment small enough for the borrower to qualify.
But as we just discussed with the rate term puzzle, while this achieves affordability today, it dramatically increases the total cost of interest over the lifespan of the loan.
By hundreds of thousands of dollars, potentially. It's solving an immediate problem by creating what is essentially a generational debt burden.
Okay, so let's take that benchmark, the 30-year fully fixed loan, and travel the world. Because the moment you step outside of the US and a few other specific countries, the term fixed rate mortgage suddenly becomes, well, negotiable.
It really does. Let's start with our neighbors to the north, Canada. Their system is fundamentally different.
How so?
In Canada, while the mortgage maturity period is commonly 25 years, the rate itself is typically only locked for a maximum of 10 years. Often it's only 5.
Wait, so what happens after 10 years?
The Canadian homeowner must, by necessity, renegotiate and refix their rate 2 or 3 times over the life of their mortgage.
That introduces some serious stress. The certainty of your payment is only guaranteed for the first few years.
Exactly. At the end of that 10-year term, they face what is essentially a financial crossroads. They have to absorb whatever the prevailing interest rates are at that moment. They trade long-term security for what is often a slightly lower rate during that initial fixed period.
Now, contrast that instantly with Denmark.
Denmark stands out as one of Europe's true anomalies. The 30-year FRM, the American gold standard, is the default standard form of home loan there. Their system is built for that exact same long-term stability the FHA engineered back in the 1930s.
So it's not just an American thing.
No, it's a Danish thing too.
Okay, shifting to Asia, let's look at Singapore. What does
Yeah.
fixed rate mean there?
In Singapore, the interest rate is fixed only for a very short initial period, usually just the first 3 to 5 years of the loan. And crucially, after this short fixed period expires, the loan automatically converts to a variable floating rate structure.
So in Singapore, the FRM is just an introductory product. It's used to provide stability during the homeowner's crucial early years of ownership, and after that, the borrower takes on all the rate risk themselves.
That's it. And we see a similar, though slightly different, pattern in the United Kingdom.
The UK, right.
In the UK, when they use the term fixed-rate mortgage, they are almost always referring to an adjustable rate mortgage, where the rate is just locked for a short introductory period, usually between 2 and 5 years.
2 to 5 years, that's barely enough time to settle in. What happens when that fixed period ends?
Because of that short lock-in period, the UK market is characterized by incredibly high rates of refinancing. Borrowers tend to switch products every few years, jumping from one fixed introductory product to the next.
So they're playing a continuous game of financial musical chairs.
That's a great way to put it, hoping they lock in a new rate before the market spikes.
This raises a really important question. Why? Why does the UK market favor this short-term fixation over the long-term certainty we see in the US and Denmark?
The answer is structural, and it's tied to the history of their primary lenders, the building societies.
Holding societies,
Hmm.
like credit unions.
Sort of. Historically, they've been required to fund at least 50% of their lending capital through deposits from their members. This means they are largely borrowing money short-term.
And if they're borrowing money short-term, but they're lending it out long-term at a fixed rate, oh, that creates a huge problem if the central bank raises rates.
Precisely. It creates what's called an asset-liability mismatch. Think of it this way. They are paying a fluctuating short-term rate to their depositors. That's their liability. But they are earning a fixed long-term rate from their borrowers. That's their asset.
And if the liability cost goes up, but the asset income stays flat, they're in trouble.
Big trouble. If their short-term borrowing costs suddenly spike, if they have to pay depositors 5% interest, but their fixed loan is only earning them 4%, their business model is instantly unprofitable, maybe even insolvent.
Okay, that explains why lenders in the UK would prefer variable rates. It transfers that interest rate risk right back to the borrower, which helps the lender balance their books against market changes.
And that lender preference, over time, it filters down to consumer preference. You couple that with the common desire for the lowest possible initial monthly payment, and the short-term fixed loan became the dominant market structure in the UK.
Our final stop on the world tour is Australia, which offers a fascinating hybrid. Their market includes what they call honeymoon mortgages.
Right, these are introductory products with really short periods, sometimes only a year, and
What's unique is that the fixed element might not even be a fixed rate per se.
What is it then?
It could be a fixed reduction in the interest rate for that period. So you might get a fixed 1% discount off the standard variable rate, but only for the first year.
And the Australian product is often highly flexible, which seems, contradictory to the whole fixed rate concept.
It is. The Australian mortgage model often combines these introductory rate structures with some powerful flexible features. The most common is the ability for borrowers to overpay their mortgage principal without any penalty.
Which, as we know, saves a ton on interest. A ton. But here's the kicker. They are also allowed to redraw those overpayments later if they need access to that capital for an emergency or an investment.
So it's like a line of credit built into your mortgage.
In a way, yes. The Australian system provides this short-term incentive, but it integrates a flexibility that lets the borrower manage their own risk and liquidity against the rigidity of that initial fixed structure.
It just underscores your earlier point, doesn't it? In global finance, you have to always ask, how fixed and for how long?
Because the answer changes drastically depending on the historical context and the prevailing regulatory pressures of that country's financial system.
All right, let's pivot back to that central choice facing any borrower in any market. Fixed versus adjustable. We've established that the FRM is usually more expensive than the ARM, at least initially.
Right.
But we need a deeper dive into the why of that cost difference, because I think it helps frame the entire risk transfer mechanism. The fundamental reason that long-term FRMs are priced higher than short-term or adjustable products is all explained by a financial concept called the yield curve.
Okay, let's unpack that. What does the yield curve tell us about interest rates?
The yield curve is basically just a line on a graph. It plots the interest rates or yields of bonds or loans that have the same credit quality but different maturity dates. And generally, in a normal, healthy economy, that curve slopes upward. Meaning the longer the term of the loan, the higher the interest rate offered. Lenders require more compensation, a premium, to lock up their capital for 30 years versus locking it up for, say, 1 year.
Because time is money.
Time is risk, specifically interest rate risk and inflation risk. Lenders have to be compensated for that extended uncertainty.
So the higher starting rate on the FRM isn't arbitrary at all. It's just a reflection of the standard upward slope of the yield curve. We should probably quickly mention the rare exception, though.
Of course, that would be the inverted yield curve, which is when short-term rates become higher than long-term rates. It sometimes signals that a recession might be coming. But the default expectation, the one that justifies the FRM's higher starting cost, is that time and duration equal greater expense.
So this higher starting rate on the FRM is, therefore, the price you pay for a complete risk transfer. You, the borrower, are handing all of that interest rate risk over to the lender.
That's it. If rates rise dramatically, the ARM borrower faces escalating payments, but the FRM borrower's payment remains completely constant.
The fundamental decision then becomes, are you willing to pay a known premium today for total certainty over 3 decades?
Or are you willing to accept the risk of future rate hikes for the potential to save money if rates fall or stay stable?
It's a decision that's impossible to make perfectly because you'd have to predict the future. However, financial economists have studied this decision extensively over long periods. What does the data tell us about who wins this gamble most often?
The findings, revealed through these really comprehensive studies, are genuinely surprising to a lot of people. The majority of borrowers who choose adjustable rate mortgages, the riskier product, end up saving money in the long term compared to their fixed-rate counterparts.
Okay, that is a critical finding for anyone listening who is considering a mortgage. The data suggests that for the average borrower, statistically, flexibility pays off.
It does. But, and this is a very important but, we have to immediately balance that finding.
Okay.
The same studies clearly conclude that a significant subset of ARM borrowers ends up paying significantly more, sometimes dramatically more than if they had just chosen the fixed-rate product.
And when does that happen?
It happens when rates spike unexpectedly and then stay elevated for longer than the borrower can withstand. That's what often leads to default or forced sales.
And this is where we have to bring in the real-world context of risk realization.
Yeah.
The ARM was the product that played a central role in the 2008 financial crisis.
It's a huge role, especially when it was combined with some very lax underwriting standards.
Right. In the run-up to 2008, a lot of people were sold these teaser rate ARMs. The initial low rate only lasted 2 or 3 years before it reset or adjusted to a much higher, often crippling interest rate.
They took the risk, but the spike in rates was combined with falling home values.
A perfect storm.
It left them unable to refinance or sell. The risk that's inherent in an ARM, that a catastrophic payment increases, it was realized for millions of people, and it led to widespread financial ruin.
That history is why this choice is so profound. The choice for you, the listener, it balances the high probability of saving some money, that's the majority outcome, against the low probability, but incredibly high impact, risk of catastrophic financial distress. That's the minority outcome.
So the ultimate conclusion for the listener facing this fixed versus adjustable choice is really a psychological and a practical one.
How so?
If current rates are historically low, the FRM is probably worth the higher premium because the risk of future rates increasing is quite high. If current rates are historically high, the ARM offers the best potential for savings. But only if you have a high tolerance for risk and a really substantial financial buffer to absorb a temporary or even a long-term spike in your payments.
It forces you to define your personal risk appetite. The FRM is the financial safe harbor. The ARM is the high-risk, high-reward vessel.
So we've talked conceptually about that fixed monthly payment, $6 now. Now we get to move into the engine room, the actual mathematics that generates that exact number.
This is where the principles of finance meet calculus, ensuring that after exactly $9 payments, the remaining debt is precisely zero.
The fixed monthly payment, dollars, is the result of a very precise formula that calculates the amount needed to fully amortize the loan. It is the one constant payment that ensures the principal, plus all the accrued interest, is paid off exactly by the final day of the loan's term.
Okay, let's clearly define the three necessary inputs for the calculation. These are the characteristics we mentioned earlier. First, we have P dollars of principal, the amount you borrowed.
Then we have no dollars, the number of monthly payments, so that's the term of the loan, in months. For our classic 30-year FRM example, no dollars is 30 times 12, so 360 payments.
And the most important variable to get right is $3, the monthly interest rate. People often confuse this with the advertised annual percentage rate, or APR.
And they absolutely should not. That's a huge mistake. If the yearly nominal interest rate is, say, 6.5%, you must first convert that to a decimal, so 0.065, and then divide it by 12 to get the monthly interest rate, $3. That's the actual number used in the compounding math.
If you miss that step,
The entire calculation is off by an order of magnitude. It's completely wrong.
Okay, let's walk through the specific example from the source material to make this intimidating math a bit more tangible for everyone listening.
Let's do it. We'll use the numbers provided. A principal, P dollars, of $200,000. A fixed yearly nominal interest rate of 6.5%, and a term of 30 years, so $1 to $360 payments.
So if we input $2, which is 0.065 divided by 12, and no dollars, which is 360, and $200,000 into the amortization formula, which is basically the present value formula for an ordinary annuity, just rearranged to solve for the constant payment zero.
The calculation spits out a very precise fixed monthly payment of $1,264.14.
And that single number, $1,264.14, is the foundation of the borrower's entire 30-year commitment. It's what keeps the whole structure in equilibrium.
Right. And while professionals will just use the PMT function in a spreadsheet, understanding the derivation of the formula is what perfectly illustrates the amortization process itself.
The derivation shows three key components of how the loan actually works over time. The first is just the simple dependent structure.
Yes. The formula clearly shows that the dollars cannot exist without $2 and not dollars. If the amount you borrow goes up, your monthly payment goes up. If the rate goes down, the payment goes down. If you extend the term, the payment goes down.
But the total cost goes way up.
Exactly. It shows that instantaneous link between those three inputs and the required payment.
The second and most critical component is how the amount you owe changes every single month. This is the heart of amortization. So let's look at the remaining principal after the very first month, which we'll call P dollars.
P dollars is simply the principal you started with, P dollars, plus 1 month of interest accrued on that full amount, minus your fixed monthly payment, $2.
So every month, that fixed payment teller arrives, and that payment gets split into two parts.
Immediately. The first part of your teller payment covers the accrued interest for that month. You can think of this part as renting the bank's money for that month.
And the second part, whatever's left over, that goes toward reducing the actual principal you owe.
That's the buying component. That's the equity you're building. And because the interest in the early years is calculated on a very large outstanding principal, the vast majority of your fixed payment in the first few years goes toward interest.
And only a tiny sliver goes toward principal reduction.
A tiny sliver. The analogy holds. In the early years, you are basically just renting the money. But as the years go by, the outstanding principal slowly decreases, which means
The amount of interest you owe each month also decreases.
So a steadily larger proportion of that constant monthly payment sortie shifts over to paying down the principal.
That is the beautiful linear reduction of debt that characterizes full amortization. By year 25 of a 30-year loan, the majority of your $12,264.44 payment is going toward buying your equity, and only a small portion is paying for interest.
And the third key component illustrated by the derivation is the endpoint condition. The fixed payment is meticulously chosen to guarantee that the final remaining principal after the final payment, PNDFI, is exactly zero.
This is the mathematical guarantee that the FRM provides. It means the amortization formula is the financial engine that calculates the precise constant required to ensure total debt retirement at the agreed-upon deadline. It provides that security that was just missing from the financial landscape before the FHA standardized this structure.
It's truly the culmination of time, interest, and principal, all managed by one precise constant number for 30 long years.
So as we conclude this deep dive, we've really tracked the fixed-rate mortgage from its origins as this revolutionary safety product in the 1930s,
All the way through the complexities of its math.
to its wildly varied application across all these different countries.
And that stability of the U.S. and Danish long-term fixed rate is just such a sharp contrast to the short-term refinancing-heavy models of Canada and the U.K.
It really is. But in every single market, the core trade-off remains the same. The FRM buys you stability at a premium. It guards you against future interest rate shocks.
But it makes you vulnerable to that inflation paradox if rates happen to drop dramatically.
You are paying for certainty, and that premium protects you from the long-term risk of time. But let's end with how the lender manages the risk they take on.
Right, because they don't just sit there and pray that rates stay stable for 30 years.
Not at all. They use high finance to neutralize the risk completely.
And this is the connection point that ties your home loan directly to the global capital markets. When a lender issues a massive portfolio of 30-year fixed-rate mortgages, they have a massive liability on their books, a fixed rate in a potentially volatile market.
Yeah.
So how do they hedge that?
They sell off that fixed risk using financial engineering. They engage in what is called a fixed-to-floating swap, which is a type of derivative.
Okay, what does that mean in simple terms?
Essentially, the bank agrees to exchange the fixed stream of interest payments they're receiving from you for a variable or floating stream of payments from a counterparty like a major investment firm.
So the lender keeps the stable payment stream from the borrower, but then they use the derivative market to trade that stability for a floating rate. Why on earth would they want a floating rate?
Because if the central bank raises short-term rates, the bank's own funding costs, what they pay their depositors, also rise. By holding a derivative that pays them a floating rate, they receive more money when rates rise, which perfectly offsets the higher cost of their funding liabilities.
So they transfer the fixed rate risk to a specialist counterparty who is better positioned to handle floating rates.
They do. It transforms the fixed-rate mortgage from a simple loan contract into a piece of a much larger global market designed to manage and distribute risk.
And I assume this requires some extremely complex mathematics to price correctly. You have to determine the value and risk of that rate optionality?
Oh, absolutely. This is where models like the famous Black-Scholes equation, which was originally designed for pricing stock options, come into play in valuing and managing these interest rate derivatives. They help the lender assign a precise numerical value to the uncertainty of future rate movements.
So the next time you look at your fixed monthly payment, remember that it is the stable anchor of this massive, sophisticated financial operation designed to manage risk across decades, connecting your kitchen table commitment to the deepest concepts of financial mathematics and global markets.
It's a number engineered for certainty, but managed by speculation. And that complexity is definitely worth exploring further.
We'll see you next time for the next deep dive.